March. How's everybody doing today? Let's get started. Let's kick things off with a little risk disclaimer. We understand there's risk in trading. Please and always use trade capital only. Do not trade with money you can't afford to lose. Whether trading stocks, options, futures, forex, cryptos, you know the risks. All right, all good. Nice to see everybody. Happy Friday. Lots to talk about today. It's been an interesting week to say the least. We did survive FOMC. I actually had a pretty nice rally off of that. So from the little flipperoo from 2 to 2:30 on Wednesday to 2:30 3 o'clock and the last day, you're looking at a bullish push from FOMC to yesterday. Now, look at where we are today for the pre-market. Futures pointed downwards. We closed at 441.07 yesterday. All the indices closed in the green. SPY was up 1.25. DIA up 1.2. Q's up 1.21. The VIX is down. And we're looking at thinking like, hey, that'd be nice to carry this over into Friday. Take a look at maybe, getting some stocks called away. I'm going to take a look at those this morning, but we're down to 436. So we're going to see what happens. I mean, if we end up gapping to 436, does this go from high to lower high to lower high and we start to flush back down? I don't know. We'll find out. Or we start the day low and then we use that as an opportunity to buy and we keep pushing away, trying to break some structure here to the upside and potentially even break this channel. If there's a little corrective channel on the SPY in some of these major indices like so, yesterday's close was kind of a clue. But if we gap lower and fade lower, then this is nothing more to me than fade the rally once again. And the market is still not convinced that we're going higher yet. Interesting reads. I'm going to take a look at some stocks that I may lose this week for profit. Twitter is one of them. If Twitter stays above $35.50 and $35, I'm going to lose that this week for a couple bucks a share. Not too upset about that at all. Palantir is another one. If you took the trade with me, I've got a $12 call that I'll lose it at. I mean, I own the shares now around like $10 and change after some option plays. So if it stays above $12 today, that's a good thing. I'm going to set a chart alarm actually at $12 and see if it stays above it. So back to covered call level. And if I lose Palantir again, a couple bucks a share, no big deal. Chewy. Chewy's up to 42. I've got a break even at 40.87. I've got a $45 call out to 2 weeks from now on April 1st. I also have another break even at 56.96. So I'm hoping this stock responds nicely. And I believe we took another trade in this yesterday in equities on demand in the trading room. I'm pretty sure we did. We did. So we have an April 1st 41.50 by 41 credit spread. And that is also in, just in case it goes against us, that's also post earnings. There's a 329 earnings. We sold this bull put option, but I also did a covered call out to April 1st and lowered my cost by like $2.10 or $2.15, which was actually pretty solid. But a lot of that was because of the earnings premium. So if I lose the stock, again, I'll lose it for like $4.13 a share. I have the insurance to the downside with that bull put spread. But I do like Chewy overall, even though it's tech and tech's getting beat up. Coin. Responding nicely off the lows, which I'm happy to see. I'll set a chart alarm at these recent lows, 151. My break even on Coinbase is 199. So I'm just going to sit tight. I have an expiration this Friday, today, 210, which I doubt we're going to get to. So that's just going to help me lower my cost, and I'll keep drilling the cost down on Coinbase without being too particular and too aggressive on the covered calls because, obviously I'd like to let this stock run and recover if we get back to 220 to 260. I mean, I'd like to own it, obviously, at 199 or lower and have all those potential dollars per share for profit. What else? International paper. This was responding to the upside pretty nicely, 44 and change. Break even's 47. So I'll keep riding that one a little bit longer. Zillow, 52.99. Break even's in the 60s. Just keep an eye on that one with some covered calls expiring this week to lower my cost. CTRA. This one's responding really nicely. We did close out a long put. We may still take assignment at 27, but we're going to be in some nice profit going into next week trying to repair this thing back to the highs at $27, $28. So similar to what we did in SLB a couple weeks ago in Equities on Demand, we ended up taking a credit spread, closing out a long put, taking some assignment, and then selling a covered call, losing the stock at like a $7.40 profit per share. So this could be another trade that does the exact same thing, where it's responding. You can see your higher lows. So lows, lows, lows. These are all higher lows. And if we end up making our way back up to higher highs, I want to look at some covered calls at those highs to lose the stock once again. Hopefully turn this for a nice, $5, $6 share profit. A couple more. CPB Campbell Soup. This one's trading at 42.74. If it gets above 43 today, I'll lose the stock for a few bucks a share. SLB, hanging on to this one. I did close out the long put at 465. Our break even is, let's see here. Do the math. So we did the 45 by 44. I think we own this at 39 and change. So 45 minus 50 cents minus $4.65. Own the shares at 39.85. And we might turn around and do this all over again, where if this comes anywhere near these highs around $46, we're going to try to lose it at $45, $46 and flip this once again for a $6 or $7 share move. So some good trading going on here with energy, with financials, with stocks in general. We're getting a little recovery and a little relief rally this week post-Fed. And if some of those levels are sustained, then we'll get some tech recovery, which is nice. I'm not asking for tech to do a ton, but if you want to see what is the true kind of benchmark for tech, look at ARK, ARKK. It has obviously been a drastically beaten down stock. It is now up around 21% off the lows. So there's plenty of room to recover. I've got a break even on ARKK at 75.51. This is a trade that I'll probably be happy to let go of anywhere between $85 and $100 a share. If it gets there, I will be thrilled to take some profit on ARKK. Okay. All right. Yeah, everything's good with the audio. I just saw that audio. Yep. Okay. Hopefully we're all good there. Should be good. I can see my microphone volume going up and down. So, all right. So that covers the stock side of things. Let's look dollar index, gold, silver, oil. Dollar index. Looks like we are getting that bounce off of our past resistance breakout. This is what we talked about all week. You had a session with me, for YouTube, session on Monday, FOMC on Wednesday. This is the structure I talked about. There's no damage being done by the bears. Even though that the dollar did retreat for the last couple of days, if this is past resistance becoming support, break, retest, potential go. Right now, my idea changes there if we take out this low around 12. It's not 1230, 12306. That's this line. We'd have to come back to around 12240. If we close back below 12240, I think we're heading back down to these previous lows. We still have our support channel. We have our pivot level. But 12240, we've got to close below that. Otherwise, this is trajectory is bullish. We had, a month plus consolidation that was pretty noisy. We had a false breakout there, false breakout there. I don't think this necessarily has the look of a false breakout. The only thing that I'm noticing that makes it noisy is if we zoom out and you see that the channel resistance is right here, right? I mean, you have connect the dots, connect the dots, connect the dots. I mean, the channel resistance is right there. So if that channel resistance holds, I can see us either going, sideways or retracing a little bit with some higher volatility, but I still think that the dollar is just and honestly at this point, like, just get it over with. If the dollar's going to get stronger to this point, fine. Run back to 2015, 2016 highs, retest those 2020 highs, and then stop and drop, right? Stop, drop, and roll, says the dollar. But to get there, I mean, this is incredibly noisy and choppy. It's like, just go. It's March. Let's get a pre-summer push. Whether it's dollar strength out of the weakness, let's get something. Let's get volatility to open up. Let's see some trends, and not just get them on those, peripheral commodity currencies. I want to see some trends. We have seen a much weaker Japanese yen. By a lot, actually. Aussie yen, for example, pretty relentless to the upside. The last 3 days especially. Now, we're trading at 87.94. I did get a chance to add into my Aussie yen right up here around 87 and change, and then my next level is going to be up at this high around 90. Big round number resistance. Now, again, is this a rising wedge? It looks like we could be selling as the bull score points. We could be selling to take it back down. But if this is going to run hot to 90, I look at that resistance level to contain this trade. Same thing is true on the dollar yen. We have an excellent bar count on dollar yen. This is a trade I've been watching for a while. Is trading above 119. Okay. This doesn't change anything from my outlook. We have a small trade in from Flex at 118.40. My next trade is going to be around 120, the round number. And I'm prepared to, scale myself in with some small trades, work my way through this trade in a couple of areas up here, And the plan is to take this back down into this 200 EMA or this pocket, which was a breakout around 116.50. So there's plenty of profit potential to work with. We just have to be careful on trade size. I don't know exactly where the top is going to be, so I can't call the top with a big position. I have to test. I have to trade small and be patient, and eventually just kind of work the area. So that's something I'm watching in the forex side. Okay. All right. So we're good on the dollar index. Oil was beat down pretty bad. We had a 130 top to all the way down to $94 and change lows. Like I said to traders the last couple of weeks, watching oil, watching how it correlates with oil, all commodities, the dollar, the stock market. This is going to be number one, volatile, but are we going to see oil high, low, lower high, lower low? Do we have this type of correction in oil very fast, very quick? And if so, that's fine. Zoom out, and we might see oil do something like this. Let me use a line here. So we might see, let me make this a little bit thicker. So here, support to resistance. Now, we clearly blew off that resistance high, and the structure broke a little bit, but it didn't take long to recorrect and recalibrate, recenter. So we're still sitting kind of in this efficient area. We might see some more high volatility range bound trading on oil, but I still think that, notice this. This is angled upwards, right? This is you're seeing higher lows, higher lows, higher lows, higher lows. If oil continues to make, even with a big correction like this, as long as oil continues to make higher lows, I think this continues to stay bullish. All right. And I think commodity prices continue to look attractive to buy. So equities on demand, we've traded a couple of instruments. We traded DBC, DBB, we traded corn, FTGC. We've traded a few of those commodity-based ETFs that, from a broad sense, there's metals, there's materials, there's like commodities, like we're talking like soybeans, oil, corn, natural gas, zinc, silver, gold, right? That's what we've been watching. So I like those plays. And whether oil prices truly go higher or not, I think commodity prices in general are going to go up. I did see an interesting read last night. Stock Twits. Have anybody subscribed to it? Easy newsletter, easy to read every day. Just read it on my phone. I took a couple pictures last night. So what do we have? Number one, Amazon closes MGM acquisition. That's a big deal. That's going to be more for the streaming. Amazon's already massive enough. I haven't checked the price on Amazon. I just keep dollar cost averaging into it. But we're getting a big rally off these lows. I bought Amazon around 28.50, 2900 off these recent lows, right at this yearly pivot. That yearly pivot's 28.14. If you're, paying attention to the technicals here, it is nicely off these equal lows. Amazon's up about 16%. If we get back to these highs off these equal lows, that's a 30, almost 40% rally on Amazon. I like it. I'm all for buying Amazon at 2,800 plus. We're also looking at a 20-for-1 split coming soon. Same thing with Google. Those are big deals. If you have any shares in Amazon, you're going to get 20 more. That's always exciting. Anyway, I was looking at the retail world and how things are now more expensive. And we probably know this. We probably already felt it. But here you go. Companies like Macy's have been increasing the cost of consumer goods for months now, but shoppers are finally putting their feet down. Some products like apparel have seen increases to the tune of 6 to 30% year over year. Unit sales of footwear, apparel, toys, and other goods have decreased 9 of the last 10 weeks. You know why? Because people stopped buying. I'll tell you this, like from a consumer standpoint, you probably still want to give at least the illusion that there are sales, because I'll tell you, one of the least motivating things for me to buy is going into a retail store and seeing like nothing's on sale. All right, I'm not paying full price, even if it's like the mind trick. It's like, give somebody a deal. If you're a patron, how about 10% off? How about 20% off? Like, I don't know. I guess maybe I'm cheap, but at least people are starting to notice. I, this is a side note, but it's like I play a lot of basketball and I burn through shoes like every probably 3 to 6 months, but I'm looking at replenishing them and I'm like, no, I'll just I don't know, just wear them until they freaking my feet pop out of them. But nothing's on sale. I looked at Steph Curry's brand new shoes. They're like 160 bucks. Can't find them in any sizes. You got bots and sneakerheads that like scoop up everything. It's like it drives me crazy. So we have a weird like retail world going on right now where it's like everybody's either buying everything or nothing's on sale. And in the background, it's not just retail, but it's everywhere. Prices are higher. And at some point, the consumer is going to say, I really need to budget more. I really need to stop spending money, or I need to start, at least saving. Also, this week in my Flex Room and Equities on Demand, I did share a video this week. How many of you were in the session with me when I shared that video? It was a 45-minute video. It's Ray Dalio, how to deal with the changing world order. It's an awesome animated video where he walks through all these, from the Dutch to the British to the U.S. to now where we're currently sitting. Like this changing world order stuff. It's almost too simple, but that's what makes it so incredibly powerful and probably like prophecy. I mean, I see where we're at, and he's not wrong. The hardest part is you can't just pinpoint like this is when it happens. I mean, there's going to be times we have to navigate. There's going to be this fight from the U.S. to try to prolong their world dominance, but you can smell and taste the de-dollarization. You can smell and taste the rise of China and East versus West, and we're certainly getting more of that stuff going on right now with Russia, Ukraine, and possibly China, Taiwan, if that happens. So I don't know. I mean, it's a really interesting thing. But at the end of all that, you watch that video, the one thing he says that all people, all countries need to do is you need to earn more than you spend, okay? You need to be nice to each other. I'm like, yeah, that's it. The world could be a better place. I don't think he wants to run because he's 72 years old, but I'd say Ray Dalio for president. Why not? Anyway, but it's an interesting video. Check it out. And plus, his book is awesome. If you read that book, it's a great book. And again, it's not like he's making these big, bold claims. He's not some canary in the coal mine. Like he went back hundreds and hundreds of years and just sees the correlations of this helps him prepare for the future, And Bridgewater's done pretty well by him. He's 72. I'm just happy that he's giving it back and he's not hoarding all that information. So anyway, check it out. All right. Global warming is going to be a big factor. Yeah, I mean it should be. Climate. Look, I mean, I think just the semantics alone. I think if you call it climate change, people are going to acknowledge it. Call it global warming, people are like, well, it's so cold. I live in Michigan. It snows every year. It's like, stop calling it global warming. Climate change is, in my opinion, super real. But you also have this. I mean, I don't think anybody thinks 10 years out. Very, very few like countries right now, except maybe China, because there's no midterm elections to worry about. There's no 4-year elections where parties change and complete agendas change. Maybe they can think 10 years out, 20 years out. But I look at what's the climate change promises, right? What's the the climate change accord? We're talking 2030, 2040, 2050. I mean, that is so far out in the distance right now that it's not a priority. We have current people in power politically. They're not even thinking about 2030. They're thinking about how do I stay in power for 2022? How do I stay in power for 2024? They are like term to term to term. And that 2030, 2040, 2050, those deadlines are so far out there, it's not even real. Like if you're really going to impact climate change, it's like you'd have to start now. But guess what? Most people procrastinate. And I think the world's going to do the same thing, and it will get probably devastating where it's going to be the path of no return or the point of no return. And yeah, I don't know. It's going to be ugly. I'm sure it's going to be a very real thing. But right now it's like, yeah, it's 9 years away, 8 years away. Not a priority. We got other stuff to worry about, which sucks. But that's the world, I guess, right? So anyway, list the name again, Tom. Yeah, I was talking about Ray Dalio. Ray Dalio, and the book is called The Changing World Order. I'll type it in the chat. The Changing World Order, Ray Dalio. There you go. Perfect. Okay, so what else is I looking at here? So we did Amazon. That was the MGM acquisition. The retail stuff going on with Macy's. Consumers are stepping in, saying, hey, we don't want to spend this much money. And then what else I noticed was housing. Fed's increase in rates also propping mortgage rates up above 4%. We saw the borrowing rates going up. This is a website you can check. I watch this, every week. The average 30-year mortgage, 4.5%. 4.5%. I just moved into a new house last October, and we closed at like 2.8. Okay. So that's in what? 6 months? October, November, December. So we end of October. So November, December, January, February, mid-March. 5 months. That's 1.7% higher. Now that might not seem like a lot, but that's an average of probably, I mean, for a house that maybe is, I'm looking at like median home prices at like 360, 370. That's an average of like $200 to $300 per month difference. And I'm not saying that makes a big deal, but over the course of 12 months, over the course of 30 years, that's a huge difference. Um, I mean, that's a dramatic increase. Now, it's not necessarily slowing purchasing because, if mortgage rates dip or flatten or start to drop a little bit, guess what? People refinance. So you close on a house at 4.5% or try to drill it down a little bit if you get a chance to get a window to refinance, which is expensive, by the way. And people don't realize that, oh, I'm saving some money on this refinance, but it still costs you to do that. And I think if you're saving like, 3/4, 1% on the refinance, then it's worth it. But just depends on how much time you have left in that loan as well. But anyway, it's been going up dramatically. The 10-year note, the TNX, is sitting at highs at 2.16. We had recent highs all the way up to 2.25. And this chart goes back to over a year ago that we have been watching. I had this noted on my chart with this exact same words. I mean, I'd have to go back and find the timestamp of like when we started talking about this, but this is probably um, I'm trying to think, maybe like September of last year that we were like drawing this out and saying, look, I think this is what the end of the bull market looks like. We're going to have rising rates. We know the Fed's going to have to tighten, blah, blah, blah. And we're there. Now, it's interesting to see like this is where we're at. And yet the stock market is, off the lows, but we're not making new highs. So I think that, I stand by this. I think this is truly like the top is in for the most part. I think the market's going to do everything it can to fight. I think the market's going to do everything it can to try to get back to these recent highs. This is an image I showed this week. This is a great reference. If you want to take a screenshot of this, this is super awesome. Look, this is what history has shown us for the last 50 plus years on what the market does as a reaction to the Fed. When we have these rate hike cycles, these rate campaigns, which is exactly what started this week, 50 years of history shows us that there is an 80% probability that from Wednesday over the next 12 months, the market will have a positive return. Okay? And so for 12 months to 24 months, you can see that historically speaking, 80% of the time, the market has responded with favorable movements. Now, what this doesn't show you is the reality that prior to all these hikes, the market tends to sell off aggressively. And that's what it did, right? We saw 20+% sell-offs on the NASDAQ, 20+% sell-offs on the Russell, 15% respectively on the Dow and the S&P. So we're already in a hole. And so is it easy for the market to kind of, put in a little bit of a low and bounce off that and go 7% for the next 12 months? Yeah, it's easy. Market's down almost 20%. Why can't we go up 7%? That's easy. But that 7% rally, even that 20% rally, does not get us back to higher highs. So if we take a look at this really quickly. So off these highs to lows, let's take a look. If we go, let's mark exactly where the Fed was. Let's mark a horizontal line of where the Fed started. So this was Thursday's candle, Wednesday's candle. So I'm going to go to the close of Tuesday, right? Close of Tuesday is right here. There. So that's the close Tuesday. So according to this right here, from the point of the first rate hike over the next 12 months, let's go 12 months and 24 months, and let's see what 7% looks like. Let's see what 19.3% look like. This is the average over the last 50 years. Okay, so 6.9% and 19%. Let's map that out. So from this line, let's go 7%. Okay, right now, for the last 2 days, from Wednesday to Thursday, the market's up 3.54%. Now, we're going to gap lower today. We're going to be sitting around 1.83%. I'm just going to mark it right here and say 6.9. That's the average over 50 years. So that puts us right around, let me try to get exactly 6, but that's close enough. All right, 6.88. So 455. And I'll make a note here. I'm going to mark that and put a little text box on this. So this is the 6 6.9% post rate hike. Okay? So right there, that is 455.74, give or take obviously a few cents, dollars, whatever. But that's a 6.9% post rate hike. Now let's go 19.3%. That was the other one, right? Over a 24-month period, 19.3%. So let's see what 19.3 looks like from this starting point. 19.3, guess what? That puts us into higher highs. Now, it's probably going to take 2 years to get there, I think at least. Okay, so we had our overextended, we had our euphoria, we shorted the market this year, we made some nice profit on that. Let's go 19.3%. I'll go slightly under there. That gets us up to 507. So that would be the S&P 500 at 5,000. Okay? If the S&P 500 cracks 5,000, there's your 19.3% rally off of the Fed rate hike. So I'll make a note right here. That's the SPY. And that's going to be the 19.3% post-Fed, post-rate hike. I just want to make it the same, post-rate hike. Okay, post-rate hike. Okay, and I'll put 24 months. That's a 24-month target, according to the 50-year history. And this is 12 months. Does this make sense? So because the market's been beat up, I can see the market being motivated to stay the course and try to say, look, the worst of it's been priced in. The 6 more rate hikes coming this year by the Fed, potentially 6 more, whether it's 25 basis points, 50 basis points. They're talking about a consensus at 1.9 by the end of the year. Does that derail the market from getting to this 12-month level? Or this, again, average 12-month level or the 24-month level? I don't know. If the market, think about this. When we started the year, when we started the trading year, the market, I'm trying to find that yearly pivot. Yearly pivot's right here. So when we started the year, we were at the high. So this market needs a pretty substantial recovery just to get back to the highs and say, hey, guess what? We finished positive on the year. When we were literally at the high to start the year. So if we go down to our Russia-Ukraine invasion, this market needs to rally 17% just to get back to break even for the year. All right. Now, some could say that's a good rally. I bought the dip. Well, that's great. But if you're sitting here holding highs, you're clearly upside down and you're holding to make sure I didn't lose anything. But if you're actually aggressively buying in here, you're gonna probably have a chance to get some gains. But inflation's gonna be sticky. I think energy and commodities are gonna continue to run hot. There's an argument out there being made that we won't have a climate change solution, or until we have a climate change solution, energy prices and commodities will continue to be expensive. And we as consumers will be told repeatedly that supply chain issues, blah, 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 blah. It's like, that's 2 years ago, man. COVID, sure, disruption, global shutdown, but guess what? Life moves on. Flow of goods and services moves on. Find a way to be more efficient. That's the whole point of technology. Is make it better. Why are supply chains so crappy? Is it? Do we need to fix border issues? Is it too nationalistic out there? I don't know. But it just seems crazy that this day and age, this technology, what seemed to be the easiest goods and services, is now you can't get anything that you want without either paying a lot more for it or waiting forever. Anyway, it's just really crazy. And yet, people are still willing to pay. So it's just, again, I'm just kind of using all this information it's crazy stuff. But I want to go back to what matters. Charts matter, technicals matter. This 50-year history to me means something because this is taking into account everything we've just been dealing with. For the last 6 months, all the market's been watching and worried about is the Fed. Tightening. Are they going to tighten? Are they dovish? Are they hawkish? This is a very aggressive tightening cycle as they're also tapering and tightening and scaling back purchases. Raising rates in the wake of high inflation, a 40-year high in inflation, it's a big deal. I'm seeing all these funny memes about just gas prices. Can I help you? It's no, I'm just looking somebody just walking by the gas pump, just window shopping, Anyway, stupid stuff. But let's get to it. So does this make sense? I want to keep this on the chart. I think these are important benchmarks to note because that brings this image to fruition. And if we hit these levels faster, great. Maybe it only takes 6 months. to hit that 7% level. Maybe the market's been waiting for the last 3 months to, price all this bad stuff in, price all the bear sentiment in, but the market with higher volatility just continues to grind higher now. Structure-wise, per this chart, if we are going to hold this break right in here, actually, let me go back. Something like this. Just draw a parallel line. If we're going to hold this break, if this is a corrective channel, if we hold this break, then yeah, we break, we retest, we have some room to run. But just remember that from our low to our high, this market has to gain 17% just to get back to break even. So anything above that, you're talking this market legitimately has to run 20% to the upside just to eke out, squeeze out a positive gain this year. And not just a positive gain, but a positive gain with the highest inflation we've seen in 40 plus years. You could argue that inflation's at a solid 7, 8, 9, 10%. So if we get back with a 20% rally to get to a positive 3, 4, 5%, guess what that actually means? You still lost to inflation. It's crazy, right? So it's not going to be a gangbuster year, I don't think. I think this is what I said going into trading 2022. It's the year of the trader. I think traders make money. I think investors are going to have to wait. I think if you're a dollar cost averager in your long term, you're fine. But if you are looking at I just have been buying stuff and it goes up, I don't think that's this year. I think this is the year that you've got to actually have transactions to help you make money. You got to buy those lows. You got to take some profit. You got to keep your margin, at the ready, and keep your your cash pretty your free capital flowing, right? All right. Anyway, okay. I guess that was my long-winded PSA for the day. Anything else I need to check? One thing that has been that I probably will not get taken away this week is Vixum. This was a stock that I own at $30.70. I sold the covered call, expires today. It's not above $34. It's close, but I doubt it's getting there. But I'm going to set a chart alarm anyway at $34 just in case. $34 and then lose stock, question mark. I don't think I'm going to get there today unless we see a big drop in the stock market that allows the VIXM to rally. This goes back down. This expires today. And next week, I own the shares at $29.70. I'll probably do another 34 to 34.50 covered call, try to drill the cost down again. That'll lower my cost even more. And eventually I'll try to time this where I lose the stock. If I get back down to $29.50, I'm going to buy some more. This is an instrument that I like. I like buying when we have these really nice support levels around $30, and it is a fairly straightforward flip. I mean, from $30 to $33, you could take that trade all day for the last 7-8 months and turn that. It's about a 10% move every time. That's a 10% chunk that is pretty repetitive, pretty consistent, and it's a nice little hedge to play against the market that's going against you or choppy and volatile, or you might be waiting it down in some other positions. Make sense? All right, so I'll be watching that one today. Equities on demand, we have class in the next 27 minutes. I want to talk about some currencies. Let's go back to that currency strength chart for today. I saw the euro is one of the weakest. Just checking everything on the phone this morning. Let's go to yesterday, refresh this. And if you have any stocks or cryptos or forex pairs you want me to take a look at this morning, I will. This is today's currency strength chart. So volatility is fairly contained, but we have broken to the downside. During that London session, the euro was close to baseline, but has made a nice run to the downside. The JPY as well, one of the weakest currency pairs along with the euro. So I didn't see any major data coming out of the eurozone this morning. That was the Monetary Policy Committee yesterday for the pound. Friday today, we have CAD retail sales came in positive but negative revisions, so mixed. I don't see any major euro news this morning. It's a little bit strange. We have some pullbacks on some of those Swiss pairs. I was looking at some good positions this week on CAD Swiss. Oops. CAD Swiss trading at 74.16. I'm still long. I'm still adding on dips. If traders are with me on this trade, any pullback, I'm buying a dip. If it retraces all the way back down, I'm buying dips. My target is up here towards 75 and possibly higher. But I'll be pretty happy at these resistance levels around 7,500. And I'll be thrilled back to these 2019 levels around 7,600. And I also think that in the bigger picture, I think CAD Swiss is a potential instrument from wave 1, wave 2, wave 3. If this is a wave 4, I would love to see a wave 5 that truly gets us up to this Swiss National Bank pocket around 8,000. So, I am still very interested in building CAD Swiss longs, wanting to take some profit, looking left at all my levels. But if we get a decent trade and trend, I mean, this trended here really nicely. This trended here really nicely. I also think that we're due for another trending cycle. Another decision cycle on the CAD Swiss would be excellent. And I think we have levels all the way up to 79 and 8,000. So that's a pair that I continue to stay long and building on. I've taken profits a lot over the last, 8-9 months. We have been trading this with robots. We've been trading this with just buying support levels between 71. Palantir's up to 1250. That's freaking great. Hopefully it goes higher. We're at 1249. Go, go, go. Get out there and get up there. Twitter, I'm just going to check that really quickly. Twitter's at 38, even better. I did tell traders, and we'll talk about it more in class at 10 o'clock. If we're up to like 39, 40 bucks, I may consider rolling that Twitter. What's up, bro? I might consider rolling this covered call on Twitter up to maybe 36 or 36.50. Grab an extra 50 cents to $1 per share. Try to set it up to next week expiration. We'll take a look at that today in class. All right, CAD Swiss, we're good. Euro Swiss, I saw a request on that. Wayne says Euro Swiss buy limits. Wayne, if you've been in class with me, there's literally like tons of them. A couple levels I've been really interested in on the Euro Swiss. Right here, past resistance becomes support. So past resistance becomes support around 103. Past resistance becomes support around 102. I mean, I'll make it really simple. I like buying again at 103. I like buying again at 102. I like buying again at 101. I like buying again at the zeros, 1.00. So that is area right here. 1, 2, 3, and 4. Those would be my add-on spots. Because what I'm still interested in following is the pursuit of this Euro Swiss to head up to this yearly pivot. And we've also broken this recent trend line right here. So if we have a trend line break, comes back to retest, and then we get a rally, awesome. Let's get back to 106 plus. So that is a nice profit target for me above this high, above that yearly pivot. And I'm also looking for a bigger picture swing, which may look something like this. And we've detailed this so many ways in the flex trading room. Is this going to set up for a larger reversal pattern? Because if it does, my longer term destination on Euro Swiss is going to be 109, right? So it continues to be a kind of an evolving currency pair, but I'm excited for hopefully the big picture profit. And CAD Swiss is very similar, where it's big picture profit. Pound Swiss, I'm still holding based on this larger channel, but I'm looking to get back up towards 25. If we break this channel, I think this has all the room in the world to get to 1.30. We get the dollar Swiss, which is trading at 93.66. This is a spot that we just broke out at 93.50. This is another past resistance becoming support right in here. Past resistance becoming support. Hopefully this is high-low. We base here, and then dollar Swiss starts to go higher. If it comes all the way back down, guess what? I'm willing to accept if the dollar Swiss drops, because I'll buy more, I'll buy more, I'll buy more, I'll buy more. I'll buy more. That's fine. But if the dollar Swiss drops, hopefully that is just led by the dollar and not so much the Swiss. Because if it's led by the dollar, that means euro dollar goes up, that means Aussie dollar goes up, that means New Zealand dollar goes up, that means pound dollar goes up. Those are great trades. And I'm looking for that clarity on the dollar index. Okay? But if it's all led by the Swiss, we just have a big reset button again. Okay, Baidu crossing 155. Holy shnikes, I might not even get a sign this week on Baidu. You got to be kidding me. That is going to be really interesting today, traders. Baidu at 155. That's incredible. So my break even's 141.63. I'm going to set a chart on like 160. We've had a big recovery in China tech stocks this week. Alibaba, Baidu, and we've talked about a couple of them this week. But if we get back to 155, I don't take assignment. My break even's 141.63. If I'm assigned at 155, I'll know that later today by the end of the day. But if we're up to like 160, then I don't take any assignment, and I end up making. Let me find my break even here on Baidu. So Baidu would be a total profit of $6,525 and taking 0 assignment. I'm okay with that. Now, it would be nice. I'm in 500 shares. Let me see what I would make here. So if I'm assigned at 155, I did a credit spread at 255 and a long put at 1050. 141.95 is my break even. if I did a covered call and grabbed a little bit more profit out of that, let's say I just lose the stock at 155 times 500. That's not right. What's up, bro? Let me do that math again. So 141.95, 141.63 minus 155 times 5. There we go. So 66.85 would be right. If I take ownership, 66.85, which is fine. And I missed the opportunity to cash in that long put for, $40, $50. Instead, I only got like $10.50, which, man, that was close. Like at this low, I was looking at cashing in at right $100 and I missed it. But hey, if you save about 155, no complaints. I'll get some nice cash back, and what a turnaround. So I'm wondering if Chinese tech and large cap will continue to help the broader market recover. FXI is another one that we're in this week. I bought shares at $30.80. They're up $1.27 right now, and hopefully we will see this continue to rally and recover. Okay, Euro Swiss were good. Luke saying pound CAD, pound CAD. If you're below 6,600, don't hold pound CAD. Now this is going to be really, really close. Okay, and Luke, you should know this from class, right? If we are sitting here at these lows, it is, again, there is a potential falling wedge in here where this is getting into oversold territory. But I will say this, looking at this chart, unless we break this trend line or we get back above 6,600, I'm not going to force a buy position right now, because if oil bounces hard and starts to rally and we're starting to get back to 105, 110, 115, 120. Remember, oil's highs at 130. That's a gettable target right now. Even though the previous highs were 110 to 115, 130 is now a high the market can come after. So pound Canadian, if we start drifting way lower, like if we're down to like 6,500, then I think that any retracement back to 66 is look to sell, and that resistance holds, right? But if we can, hold this area, I'd say by like next week, and we get back above 66, I think we have a chance to put in a low, and this recovers. We got a nice pocket trade back towards like 6,800. We can obviously get back to these highs. We got a monthly and weekly pivot cluster at 7,100, but that would be also putting in a pretty dramatic bottom on the pound CAD. It can certainly happen, but to me, I'd feel a lot more comfortable. Number one, price on the right-hand side of the trend line. Number two, closing back above 6,600. That way I can put in more of a stop area here and see if this wants to go up. But it's a good, clean technical trade. It's just I don't want to hold long if this thing's going to drop and just stay on the left-hand side of the trend line, because I would rather sell it for 600 pips to the downside. Airbnb recovering. Man, we got some good stuff, man. It's good stuff. Airbnb, BNB, and we've got Baidu. I've got to watch these prices today. Airbnb, I may not get a sign on that one. That could be another one where it turns out to be a nice chunk of profit. My break even's 151. Airbnb, I think I have a covered call. So I have the 155 covered call out to next Friday. We'll see where price is at by close of today. But if we're up to 160, maybe I can bump up my covered call and roll it by another week or so. But like we talked about in equities on demand, if I just had the chance to get rid of some of these trades and $3, $5, $10 a share, it adds up. It adds up really quickly, actually, and that would be a nice little wave of profit. Let's see here. Let's see. Daniel, is that you asking equities on demand? Is it specific to options, or you can just buy and hold and sell? I mean, it's everything. If you want to trade stocks and options, that's the best way to do it. I do trade a lot of options in that class. We're super flexible. I said this is the year of the trader. I'm not interested in buying and holding. If you want to buy and hold, I mean, you can do that with YouTube videos. Like learn how to evaluate a stock, learn how to use some scanners and screeners, find stocks, filter stocks. You can do that crap. Buy and hold dollar cost average. That's the easiest solution ever. You don't need a class for that. But if you want to learn how to trade and manage options, lower your cost basis, flip stocks and repair them. I mean, this has been our equities on demand. We trade a lot of options. You're going to see a lot of wins, lots and lots of wins. So we trade with a lot of confidence. We know exactly what the consequences are for all of our trades. We are typically a seller of the premium. We don't just go long calls. Okay, I hate buying calls. I hate buying puts. Reason why is it's so price dependent that I'd rather be the seller. I'd rather collect the premium and know we have a line in the sand, know where your break evens are at, and again, use it to lower your cost basis, use it to repair stocks. And, sometimes we take ownership and flip them. We've had some big wins. This has been a class that we started this trading room back in April of last year. very successful, everyone in it. I mean, I wish we had a lot more students. We have like, 200 students in the class. And I think it's one of the most undervalued, underappreciated courses that I teach. Why? Because it is literally something we can do every single day and stay active, and you just learn some basic strategies that are freaking amazing. So I think it'll open up your eyes as what you can really do with trading a stocks and options portfolio, right? And if anybody's in class, feel free to chime in and test. I think we've done great. We've had we had an awesome year last year, and obviously it wasn't too terribly difficult to do that because everything was bullish, but we did pretty darn well. And then we timed the September effect really well. We timed the end of the year well. We timed this year's bearish market well. We're also getting in the right sectors right now. So we're trading energy, we're trading commodities, we're trading financials, and we are bulletproofing our portfolio. So again, um, it's a lot to learn, but it's like once you get the core strategies of trading options, couple simple ways to do it, know the consequences, positives, negatives. It's an awesome class. Yep. And everyone else is chiming in there. I appreciate it. It's true. I mean, we're doing really well, and it's just like anything else. Learn how to do it, and it's yours. Okay. All right. Any other requests? I'm going to go here in just a couple of minutes. MARA. Yes, it's above the credit spread level, correct? So MAR is trading at 26.71. This is totally fine. If this closes today above $26, we will lose on a bear call spread, but we're going to win on our overall remainder for that J Lizard strategy as well as our credit spread. We're going to walk away with $2.35 of profit and take zero ownership. So, I mean, even for a one contract trade that cost us what? What would be the margin that it would tie up? So the bear call spread doesn't cost much. The put was at 25. You're looking at a trade that maybe costs you $1,250. Okay, and you're going to make $235 divided by 1250. You're making almost a 19% return on your investment in one trade within like a 1 or 2 week period. And all we have to do is see price stay where it is right now. If price falls a little bit, falls back to 26, falls back to 25.50, we can maybe up that a little bit. We're going to talk about that in class in 13 minutes. Okay. All right. And one last thing before I go, Winnie, sure, I'll take a look at that Swiss yen. Okay, Swiss yen is trading at 127.39. I did add a sell trade to my Swiss yen. It was filled as a pending sell. I sold it at the high at 127. I think it was filled at 127.05. Let me confirm that right now with my Forex chart. 127.05. Right here. Swiss yen. Correct. So that trade was 127.05. So my break even is now bumped up to like 124.63, and I'm just gonna sit tight on the Swiss yen. Um, another trade that to me looks like we have, and again I could be like trying to guess where these tops are at on the yen pairs, which I obviously don't want to do. But for this higher time frame, there may be some upward mobility here. Like maybe this runs a little bit unhinged. But I think here's what I'm looking at for a lot of these yen crosses. We have these big FOMC breakout pockets that were running up hot. Dollar yen's running, Swiss yen's running, Euro yen's been hot, pound yen's up, Aussie yen, CAD, the whole basket, right? So these pockets, and I'll show you these in just a second, these pockets right here, price is up. Eventually, when we end up peaking, we're going to come back down and fill those pockets. So the Swiss yen, to me, this is a pocket from last year. If we break the structure in the Swiss yen, this should be an excellent trade to the downside. Right? Square, I'm going to take a look at that one today in class 2. Looks like we're getting a fairly broad recovery right now. I mean, and the SPY is down. I don't know if we're getting just like these big pumps into some of these trades. SPY did gap lower, but we're fighting back. I've got a chart alarm set at yesterday's high at 441. What else? Swiss yen. So Swiss yen, just really quickly, I'm just going to stay tight on the Swiss yen, hold, trade small. If we end up scoring a little point up here and then pulling back, I am still adding to this position below 124, looking for a topping pattern, yearly pivot, pockets back below at 121. This is my big destination and my destination profit on Swiss yen. Maybe it takes the Swiss to allow the Euro Swiss to go to 109, and that's what gets me paid on the Swiss yen. Maybe the CAD Swiss going to 76 or 7,700. Maybe the dollar Swiss going to 96. All those bigger trades might have to set up for this trade to work, but I'm still going to trade it. So again, small trade sizes, it helps, but I think structure-wise, I'm not missing too much. This is also showing on the higher time frame right in here. So weekly time frame, we're making a new high in price, and we are showing disagreement in momentum. To me, that's a good thing. We have equal highs. I just think we have some hidden bearish divergence up here near these tops. Now, again, the hardest thing to do in the markets, Forex especially, is call those tops and bottoms. But when I see these alignments of we made a new high in price with no agreement, we made a new high in price with no agreement, when we see those hidden divergences, I tend to look at it like, I'm okay. I'm just going to hang tight and I'll see what this thing does for the next couple of weeks, right? A lot of these yen pairs, look at the dollar yen, and then I'll let you go. So I got class here in a few minutes. Dollar yen. Same thing on the dollar yen. We're at 119.26. Okay, if you take a look at the weekly time frame, are we at overbought conditions? Yep. It does. Look, it takes a lot, traders. It takes a lot to get to overbought conditions. That formed a top. It takes a lot to get to oversold conditions. Even though we had a bottom right here, it technically did not register oversold. So the fact that we are hitting, these slightly higher highs with this overbought condition and we're getting momentum, slight divergence. I mean, I'm not saying that 119.26 is the top. I'm not saying that 120 is the top, but I'm saying that over here with this resistance, it is logical that this resistance holds and we can sell this thing for some profit. So if it's not now, okay, then it's probably up here at 124. And if we can sell it high enough, guess what? That is an excellent trade to 116. This is possibly a retracement that comes all the way back down, like it did here, from 124 all the way down to freaking parity. That's not a trade that I would. That's not a trade that I want to miss. That's what I was going to say. It's not a trade I want to miss, right? That's a trade that I want to be starting to get involved in and confirming and adding to that position over time. Okay. But right now, I mean, if I'm starting to get involved, which I am this week, 118.14 or 118.40 is a starting point, but I might have to let it go against me a little bit since I started early. But I think we've got good timing on it. As far as the bar count, I'm just going to wait. Okay, I'm seeing a lot of 4-hour divergence. We got pockets like crazy. I'm tempted to watch this one closely and look at some stop sells to maybe start adding a little bit. But we'll talk about that more next week in Flex and in class. All right. So for traders and equities on demand, I'll see you in 8 minutes. For everyone else, thanks a lot for being with me today. Yeah, look, if you have any questions, I mean, one quick thing, like if anybody's watching for the first time, you see a lot of usual names in here, but couple things. If you just want some good content, right, you can come to the website, pulverport.com. I send out a free newsletter every Monday and Friday. Mondays are my top weekly picks. Doesn't matter what instrument. I could trade Forex, I could trade stocks, I could trade options, I could trade cryptos. It's out in a Monday newsletter like 4 or 5 p.m. every Monday. Friday's recap. For the last, I mean, I literally sum up like all of our weeks. If I went through and checked all my emails and drafts, it's like we have been consistently making profit week after week after week. If you're a trader, if you're trading Forex with me, we're making profit. If you're trading stocks and options with me, you're making profit. If you're watching cryptos, we're holding and sticking to the big picture. So newsletter is great. If you're interested in some of the trading rooms, which I just noticed here that there's not even a link for it anymore. Let me see here. Price Action Pro, they added more courses here. Did they add anything to my trading room? There you go. So Flex Trading Room, Equities on Demand Trading. Okay, so they're here. It says systems, but it should be like, there it is, trading rooms. All right, we're getting there. So you go into trading rooms, Equities on Demand, you want to learn about stocks and options, highly recommend that trading room. You want to learn how to trade Forex, cryptos, look at the big picture, have a daily routine, Flex Trading Room, check it out. Okay, I think both of them offer like a $27 trial. You can trade with me live for a month for 27 bucks. A lot of you are in it. That's why you're here. But if you're not, spread the word. Again, before you go, if you click the thumbs up button for me, I'd appreciate it. And we'll keep trading. I'm not going anywhere. I'm going to keep trading. That's my thing. All right, cool beans, everybody. Thanks for being with me today. Have a great Friday. Equities on Demand students, see you in 6 minutes. I'm going to sip some coffee, and let's close out the week on a high note. Okay, again, some nice chart alarms today that are pointing to upward targets. We're going to see if we're going to lose some stocks or some profits today, which it looks like we are. Yes. All right. See you soon. Thanks. Bye.